Hi, welcome to Absolutely Forex, your free Forex trading guide, book and magazine download site. We've been making a 5-part video series on how to make money in foreign exchange, and this is video 5. Video 5, I just wanted to provide a little bit of a summary of all of the things we've taken you through to this point, and then make a few suggestions for the future. In video 1, we just made a brief introduction to you about what time frame charts that we look at. We look at the 1 hour, the 4 hour, the 8 hour, and the daily. And in looking at the market, if we want to find a brief outline or where we expect the market to go, we add in the 200 moving average and the 72 moving average. And we look at the crossovers and how far away from the averages the markets are. And that gives us a brief picture of what we expect in the market. Or is there a possibility the market's going to trend? And other participants use other moving averages. Some use 10, some use 20. It really just depends upon the time frames you trade. So we actually have a moving average ebook available on our site, so you can learn a little bit more about it there. But those are the basic fundamentals that most traders look at when they're trading foreign exchange. Every successful trader at least looks at the 200-day moving average. In our second video, we just touched upon some of the more advanced trading methods that you need to acquaint yourself to introduce those techniques into your system, which may be based upon just the simple moving average system according to what averages you think are important. Such things as Elliott wave, looking at Bollinger Bands, looking at candlestick patterns, looking at Fibonacci numbers and what those actually mean, looking at the turtle trading system, just the more advanced systems that you hear about as buzzwords in the market that have been around for a while. So build yourself that base, add in the advanced techniques, and then move on to the next part of our series, which was about leverage. And we were trying to explain that people coming in at the retail level over leverage their accounts thinking that they can make a lot of money quickly. But the risk to that, or the downside to that, is 1 or 2 bad trades can blow up your account very quickly, because most people have the tendency to add to losing positions and not adding to winning positions, and what that does is reduce your balance quicker and quicker and quicker, or it brings the market down to one number or one situation, and if it goes against you, that's the end of your account. So what we tried to explain was that most professional traders trade with no more than 2% risk per trade, so they can come back the next day, the next day, the next day, the next day, because the foreign exchange market is always going to be there. So there's always opportunities the next day. So how can we measure all that? In video 4, we introduced the concept of volatility, which gives you a guide as to how wide a range the market expects it to be. And as we discussed in 2007, the volatility was between 5 and 8%. In 2008, the volatility went up to 27%, and the daily market range expanded to an extremely wide level, and so you had to incorporate that into the trading system you used according to your win-loss ratio, your moving average system that you looked at, the advanced systems. You had to incorporate that so that you could make the most money from that, because it does provide a large opportunity. But at the same time, if you don't have a trading plan or a trading strategy, that extra volatility could just wipe out your account in less than 24 hours. Then we also discussed taking into account the news that occurs on a weekly basis. There's news events all over the world that can cause the foreign exchange market to jump 100 or 200 points in just a short period of time. So you also have to incorporate that risk, or know the times of the day when those numbers are being released, so that you can pay attention to your trades and know exactly where you need to adjust your stop loss or take profit, or reduce your position size, reduce your risk, or add to your risk if the market moves as you expected it to make the most amount of money you can. And I think the last thing that comes into it is choosing a foreign exchange broker that fits your trading strategy. If you're a moving average trader who trades less, who doesn't need the most accurate pricing, you're just leaving orders in the system, then every foreign exchange broker, you can execute through them. But if you're a trader that wants to trade more, wants to trade higher leverage, which is against what we're advising, then you need to find a broker that has a no dealing desk option so you can get in and out of the market as quickly as possible. Because the one thing is, if you're trading for that 20, 30, 40 points, which is not what we're advising, but I know that there's a lot of people who focus on that type of trading, you have to be careful that your broker is going to let you in and out at the prices you expect. Because if they hold the price or they reject your trade, it can have a serious impact on your account. So with that, I'd like to thank you for participating in our 5-part series. I think if you look on our books available, I'm sure you're going to find a ton of knowledge there to explain to you in more depth than what we've covered in our video series. And we will keep adding more and more books to that, so keep checking back and keep upgrading your knowledge. And we wish you good luck in the foreign exchange market in 2009.